When we picture corporate power, we usually imagine a visionary founder or a celebrity CEO calling the shots. We look at a massive empire like Amazon and assume its creator, Jeff Bezos, holds all the ultimate authority. But the math tells a different story. This chart compares the ownership stakes in Amazon. Bezos personally holds about 9% of the company's outstanding shares, but three financial firms, Vanguard, BlackRock, and State Street, collectively known as the Big Three, hold 16%. The heavyweight of that trio is BlackRock. Right now, they manage roughly $10.6 trillion in assets. That is more than half of the entire gross domestic product of the United States. Here is the catch. That $10.6 trillion does not belong to BlackRock. Most of it is the pooled savings of everyday people. It is your 401k, a teacher's public pension plan, and the cash backing your insurance. Asset managers are hired to safely grow that money. But by quietly parking our collective savings across the entire economy, these firms have accidentally engineered a structural trap, one that quietly dictates both the prices we pay at the cash register and the wages we earn at work. The engine behind this system is an invention from the 1970s called the index fund. Instead of placing a massive, risky bet on a single company to succeed, an index fund cakes your money and buys a tiny, diversified slice of every single company in the stock market. Because they buy a little bit of everything, the asset managers don't need to constantly trade stocks to beat the market. They just buy the shares and hold on to them indefinitely. In the financial world, this is known as passive investing. But scale creates a strange mathematical problem. When you have trillions of dollars in client money to invest, you eventually run out of places to put it. To distribute that much cash, these firms are forced to buy a 5 to 10% stake in virtually every publicly listed corporation on Earth. The term passive investor sounds entirely harmless. Yet because corporate shares are spread so thin among millions of individual investors, holding a baseline stake of 5 to 10% makes the Big Three the single largest voting bloc in almost every major company. Universal ownership means a single entity no longer roots for one brand to win. BlackRock holds a massive, simultaneous stake in Nike and every one of its primary competitors in the athletic market. This diagram shows the athletic wear industry's shared ownership. The Big Three hold equal weight blocks of stock in Nike, Adidas, Lululemon, and Under Armour simultaneously. If a single entity owns all competitors, those corporations have no reason to fight each other. In a healthy market, Nike might lower its prices to steal customers away from Adidas. But from the perspective of an asset manager owning both, that price war just destroys profits. Lowering prices at one company cannibalizes the returns of the other, damaging the overall value of the index fund. Without a single corporate merger taking place, competing brands act as a unified neo-monopoly. They share the same owners, so they share the same goal of keeping prices artificially high across the entire industry. But if asset managers are truly passive, how do they get fiercely competitive executives to play along with this anti-competitive strategy? It starts with your proxy vote. When you contribute a portion of your paycheck to a pension fund or a 401k, you legally sign away your right to vote on corporate decisions. That voting power is transferred directly to the asset manager handling the account. At the same time, the way we pay corporate executives has shifted. Today, management is heavily compensated with stock options. A CEO's total take-home pay is directly tied to how high they can push the company's share price right now. Asset managers almost universally vote to approve pay packages heavily weighted toward these stock options. This forces corporate executives to focus exclusively on short-term market performance to secure their own bonuses. To hit aggressive quarterly targets, executives target the most flexible expense on their balance sheet: labor. While real estate leases and supply contracts are fixed, wages and benefits can be frozen or squeezed to generate a sudden, profitable bump in earnings that keep shareholders happy. This creates the ultimate irony of the modern economy. Your retirement savings are used to purchase the voting power that asset managers weaponize, forcing companies to strip away the value of your labor to keep the stock market climbing. The structural capture of the economy reaches its logical conclusion within the financial sector itself. Look at this flowchart. BlackRock's biggest investors are Vanguard and State Street. Tracking the money the other way, their largest investors are BlackRock and each other. The firms hold massive stakes in one another, creating an inescapable loop where the sector owns itself. Operating at this scale normally triggers intense government oversight. Banks are subjected to strict stress tests and capital requirements to prevent economic collapses. But asset managers dodge these banking regulations through a specific loophole. They self-certify to the government through annual letters that their investments are strictly passive. To protect that lucrative loophole, they spend heavily on political lobbying. Over the last 2 decades, BlackRock alone has hired dozens of former central bankers, regulators, and government officials from institutions like the U.S. Treasury. They have built an economic fortress. By consolidating ownership across every industry, they avoid free market competition from below, and through aggressive lobbying, they remain insulated from regulatory oversight at the top. The stock market was originally designed around the concept of distributed ownership. In 1945, regular households directly owned 94% of all corporate shares. Today, the distribution is wildly skewed. The wealthiest 10% of Americans own 86% of the stock market. The bottom half owns virtually nothing. Despite claims that shareholder returns benefit everyone, the profits only flow upward to a highly concentrated sliver of the population. We no longer operate in a system of shareholder democracy. Instead, we finance a shareholder oligarchy, one that uses our own retirement savings to buy up the economy, ensuring that everything we need costs a little more and every hour we work pays a little less.